Hey, it's Stuart. My question of the week this week is from Josh, and it's a really great question because I think a lot of people are going to have the same question. Josh's observation is a lot of my blogs and podcast topics are about high income earners and high net worth clients, but he's asking me, what about the average Joe? And he says, for context, we've got a family home in Melbourne with a small mortgage, a family of five, obviously three kids, and he's a PAYG employee as well. And so he's sort of asking me, what do I do? Do I invest in a sort of regional area in property, so not just blue chip? Do I wait and try and save a deposit? Do I invest heavily in the share market, save cash, rent invest? Or do I invest a bit of sweat equity and renovate the family home or something like that? It's a great question, Josh. And of course, a lot of people can't afford investment grade property. And it's kind of part of its appeal that it appeals to the wealthiest 20% of Australians, of course, that can keep pushing those prices along because their financial capacity isn't closely tied to their income. But the reality is, you need a budget of 800,000 plus to invest in a really good quality property in a capital city location. And not everyone can afford either the borrowing capacity or obviously the ability to service a loan of that size. So my colleague, senior planner Campbell Wallace, is actually going to write a blog that he's going to publish through the Christmas break, which asks the question, what level of capital growth do you need for property investing to still be better than investing in shares on an ungeared basis? And it's a topic idea that he's come up with, and I think it's a really great one. And I'm actually looking forward to finding out the answer. It's kind of interesting. So maybe wait until sort of December, early January, until Campbell publishes that podcast on Investopoly, by the way, because I'm looking forward to that too. That might go some way to help answering your question. I did write a blog in late March 23, and the subject line is how to buy the highest quality property within your budget. So if you go to our website and search for that topic, in fact, I might ask Ivy to include the link to that blog in the comment section underneath this video. So have a look at that. And I talk through, okay, if you can't afford blue chip, where else do you go from there? Look, subject to what Campbell finds out with respect to, gearing in property versus investing in the share market, my gut feeling is the best approach, or what I would do if I was in your shoes, is I still think investing in property is probably better just because of the gearing element. And I think I would employ a couple of different approaches. I would go to a regional area, but I'd try and buy the best quality property in that regional area. And in the blog that I wrote, if my memory serves me correctly, I think I talked about sort of Ballarat versus Melbourne, as I used Ballarat as an example of where, you could buy a stellar asset for a lot less than what it would cost, a commensurate quality asset would cost you in Melbourne, for instance. I would buy mostly land, and I would use some of that sweat equity you talk about. I would look for ways in which I could contribute towards the growth of that asset and the income profile of that asset. So that is, I would buy something that's in a great location, and then I would improve that asset. So make do some renovations, those sorts of things to improve its income profile and also to build wealth. And the whole idea around that is that if you reduce then the amount of money it's going to cost you to hold that asset, what you do is you increase your internal rate of return because you're putting less money into that asset and hopefully you're still getting a good level of capital growth. So I think that's what I would do if I was in your situation. I'd still use property. I'd have a look at that blog at trying to still apply all the fundamentals, but according to your budget. And what I would be careful to do is avoid areas that might look like or feel like you're getting better bang for buck, but you're not really. So, for example, you might be able to go and buy a house and land package out in a new area and you've got yourself a 4-bedroom home and on a 400 square meter block of land, etc. It's brand new. the yield's probably going to be pretty good, all those sorts of things. I wouldn't be attracted to that. I would actually prefer to go and buy, a sort of period style property in Ballarat somewhere that's in a really sought after pocket. Again, have a read of that blog. It's a great question, Josh. And I think also for you and all the listeners, look out for that blog by Campbell, which, as I said, he's going to publish in December or early January. I too are very much looking forward to reading that analysis. Thanks so much for the question, and thanks so much for listening. Cheers.